Pleasure to be here. Thank you very much. I think a couple of things have already been mentioned throughout the day that institutional investors' role in the private markets and the exposure, right, they're seeking for private markets has increased significantly, and they are going for the hunt for returns in this market as well. And one can see this based on numbers. Asset under management in the past 10 years has doubled and is projected to increase further in the next 4 years, almost by 50%. And the alternative asset class continues to power the growth kind of from the LP side of things. And to serve the even more diverse and sophisticated and demanding universe of LPs, the GPs have adapted, and changed and evolved over time as well. For example, by creating bespoke solutions, driving operational kind of improvement inside out. And I think Olaf Helen, the chief digital officer who spoke yesterday, and I managed to catch up on the blog as well. He mentioned that we should practice what we preach from the GP perspective. And I think this says a lot about what's going on in the market, and in particular when you look at the digitalization within the private equity space from the GP perspective and what the LPs expect from them. Simultaneously, the private market became a very kind of crowded place. We've seen 12 times EBITDA multiple today presented by David Rubenstein. So I think another indicator that a lot is happening, and it's a very competitive playground. And what we want to do today is basically discuss the implications, on the rise of the private market. And to discuss this matter, I would like to welcome a pristine panel, a group of panelists. Thank you very much for joining us. Peter Cornelius, Managing Director, AlpInvest, which is part of the Carlyle Group, and with over 38 billion asset under management, investing in primary funds, secondaries, and co-investments globally. Further, Elias, Korosis, a partner from Hermes GPE, focused on fund investments in the lower mid-market and co-investments as well. And last but not least, Helen, partner and head of the European investment team at Pantheon. Pantheon invests in private equity, in infrastructure, real assets, as well as debt, with 47 billion in asset under management. And the firm is also managing a publicly listed vehicle, Pantheon International PLC, which is an investment trust and that invests in funds globally, and is constituent of the FTSE 250. Thank you very much. Let's maybe kick off and look at the changing dynamics between the public and the private markets. As mentioned earlier, there's increased demand from the investors for the private markets, increased dry powder we've seen as well, and that kind of changes the dynamic as well, how private markets are now seeking capital, looking at IPOs, number declining, for example. So how do you see the dynamic shaping up, and what are the implications for companies and for investors alike? Helen, I think you had a very good kind of point.
Well, thanks very much, and good afternoon, everybody. And thank you for attending our session, actually. I know there's a lot of competition with lunch going on outside at the same time, so thanks. Just sort of tackling this phenomenon of shrinking public markets and the corollary, which is expanding private markets. So we've done quite a bit of work on this, published a white paper a couple of years ago, and we've carried on doing some work. And the conclusions are really quite striking. So if you look at the number of publicly quoted companies in developed markets across the world, it's halved over the last 20 years. So just in the US, you've gone from about just over 7,000 companies to just over 3,000 publicly quoted companies. And if you look, even in the last sort of 10 years, from 2008, there's been a steady decrease every year in the number of publicly quoted companies. It's been about 4% shrinkage on an annual basis. So overall, you've gone from just over 20,000 companies across North America and Europe in 2008 to last year, I think there was around 13,000. Mm-hmm. So that's a big phenomenon. And what it means as well is if you look at what's left on public markets, and clearly a huge amount of capital has gone into public markets, But the average publicly quoted company is older, is about 50% older than it was 10 years ago. It's much bigger. The market cap is about 4 times what it was. And critically, it's growing a lot more slowly than private companies. And part of the reason for that is that there are whole areas of the economy, new technology that are being dislocated by brand new companies that nowadays don't go public. They remain private. So they're staying private for longer. They're growing much faster in both revenue and bottom line in public markets. And public market investors are missing out on these companies. So private market investors have woken up to this, more money flowing into private markets. So minus 4% number of public companies, plus 4% on a year-on-year basis are private companies. So what's happening is, yes, more money is coming into private markets, but actually more money is also being deployed into private companies. And that number that I just quoted is probably a little bit of an underestimate. So companies are staying private for longer. They're able to do that because they can raise money. And in the past, the average venture cap backed company would raise, I think, about $12 million. These days, the median amount of money that's raised before an IPO is 100 million. So companies don't need to IPO. They can actually gather that cash in private markets. So this phenomenon has been remarked upon now, I think, by bigger financial commentators, but it really does put much more emphasis on private markets. And I think investors realize that they can't pass up private markets. And that's what you're seeing, a lot more capital coming in. And of course, the performance, which has been 300 to 500 basis points over public markets, has also cemented that sort of enthusiasm in a low-yield world. So.
Thank you, Helen.
And Elena, I would totally agree with Helen in that if you take the journey of a company, it used to be in the 80s that once the company was past the startup stage, it could IPO and look for scale-up capital in the public markets. And now, for a variety of reasons that we can go into, the public markets are seen by most high-growth companies entering the scale-up stage. They want to stay private. They can partner with engaged investors in the private markets and get that scale-up funding. So getting to that number that Helen quoted, which is very helpful. I was reading a book written by the founder of Nike. It was really describing the beginning of that company and how much he struggled to get his funding and working capital financing right, which was all what you would call the venture stage. And then the only solution then, in his mind, even though he didn't like it, was an IPO. Now you have scale-up funding in the private markets.
Yeah. And Peter, how do you see this?
So on all these points, as far as IPOs are concerned, a significant slowdown in most markets. But also, at the same time, we see an increase in delistings. And those can be voluntary, because companies find it easier to fund operations through private capital. Or it can be involuntary in the sense that public companies no longer meet the criteria, the preconditions for being listed. That's the case in particular in the United States. Now, in the US, you have now twice as many companies that are backed by financial sponsors compared with publicly listed firms. Right? So there's a massive shift towards private markets. Now, it's not just private equity capital that funds those private companies. We see a lot of non-traditional investors in companies prior to an IPO. Think of mutual funds. Many of the mutual funds in the US, like Fidelity, have invested very significant amounts of money in those companies. Think of Uber, for example. Right? Plenty of examples. So what does this mean from an LP's perspective, from the perspective of an asset allocator? As Helen alluded to, the companies that remain public have become a lot larger. Private equity is actually relatively small. If you take the 5 largest tech companies in the US, they have a market cap that is as large as the total global private equity market. Right? So if you want to have exposure to the middle market, It's almost inevitable for you to be in private equity. The public markets don't give you the kind of exposure to different parts of the market anymore.
I think it's very interesting, this point about mutual funds buying into pre-IPO rounds. So there's a well-known quote from Andrew Boyd, who is the global head of equity capital markets for Fidelity. And he said that nowadays, the pre-IPO market is like the IPO market of the past.
Right.
So essentially, Fidelity, Bailey Gifford, all of these guys, T. Rowe Price, we see all of these guys coming into final funding rounds. And the reason for that is because, in the past, if you've been an investor in Amazon, it only spent, I think, 3 years as a private company before it went public, and you would have made an absolutely phenomenal kind of probably 600 times your return when it went public. Facebook spent longer as a private company. When it did go public, it had a market cap of over 100 billion, and therefore, the IPO investors only made 4 times their money. So, nowadays you've got to get in earlier to make that increase in money.
Or you miss out.
Or you miss
on
out.
that opportunity. Yeah. One thought I have on this as well, obviously the nature of the companies are changing in terms of intangible assets, right? And if they continue to grow or want to grow and invest into kind of new companies or acquire new. So intangible assets are treated as per accounting principles, kind of as expenses, which obviously is not very kind of good seen from the investor's perspective as well. I think that also is a burden of being a public company and also disclosure at the same time.
The cost of listing and all of this. And actually, I think the biggest thing is probably it's the short-term nature of public markets. So public market investors are looking for the next quarterly earnings. And we have a much longer time frame. We can afford to invest in the companies, they can grow, and that short-term perspective is not helpful for some of these fast-growing companies.
Okay, maybe let's look at the private markets as a maturing industry. So looking at the current public market valuations and the LP asset allocation to the private markets, where do we currently stand? Do we expect another increase in fundraising activity? So Peter, do you have insights on that?
Well, so this year is going to set a new record in global fundraising. Looking at the numbers up to mid-November suggests that this is going to be another record year. Actually, dwarfing the amounts of commitments we saw in the last boom period in 2006 and 2007, roughly $500 billion. When we speak to LPs, we hear a lot of concerns, is there too much capital? And well, I think the way I would look at this is, first of all, we have to normalize this. There's asset price inflation going on, obviously, right? So when you normalize this by domestic market cap, we're talking about 0.4% or so in terms of new inflows into private equity funds. It's not a matter of concern. We had 1.5% in the last boom period when we correct this for domestic market cap. Now, another way to look at this is how big is private equity, private capital more generally, relative to public markets. We have fewer publicly listed companies than maybe 10, 15 years ago, but global domestic market cap has continued to increase as valuations have increased. So we are talking about a universe, if you include infrastructure, if you include real estate, if you include private equity, of about $6 trillion. Of this, 3.6 trillion is private equity. Now, global equity market cap is 85 trillion. You can add 100 trillion in fixed income markets. We're talking about a volume in public markets of an amount that's approaching 200 trillion relative to 6 trillion. I don't think that this raises concern as far as I can see it.
So yeah, we are on the rise, but there's still room
I
to
think
grow.
I would see this as a substantial potential for a larger world for private capital.
You can also look at some of the global surveys that have been done. I think there was a pre-Quinn survey that was done earlier on this year, and it polled institutional investors across the world. And the conclusion there was over 50% of institutional investors were going to decrease their allocation to public equities, and around the same number were going to increase their allocations to private equity.
Yeah.
So that sort of substantiates what you're saying.
And I've also read apparently private equity will surpass hedge funds as well in terms of the asset under management. So, okay. Elias, your points, how do you see this, the market currently shaping? What is the potential going forward? Do you agree with your peers?
Well, I would say on this point, the way I would look at it very stylistically, I would say the private equity side will still keep taking share from the listed markets at the larger end of the PE market, so the LBO market competing with the listed equity ownership model. And we would think that it's a better ownership model. But the venture growth capital side growing quite a bit and taking what was the growth IPO model in the past. So the way that I think about it very stylistically is, the venture growth side is the sort of blue ocean type of play where you have new market structures, new types of competitors, very fast growth. And then when you go to the larger end of the buyout market and the listed market, you're in a red ocean world where you want to be with one of the bigger competitors, and it's more of a consolidation play. And private equity does consolidation extremely well. So it can play that market, but there you're competing with like the bigger fish in terms of the listed companies. So I do see that trend continuing as my colleagues here. I mean, the other thing that's transformational about what's happening right now, and we can speak to it without sort of talking our book in a sense because we don't major in secondaries. It is that the secondary liquidity has been a silent revolution, I think, in the private equity market. It's not silent maybe within this room that knows how much money has been raised in secondaries, but in terms of broader public perception. So private equity has always been looked at as this illiquid asset class, right? And this commands a liquidity premium and all of that. I would venture to say that for very large positions, private equity now is getting to be as liquid as the liquid markets. You can get out of a multi-billion program. Obviously, you can't get out of it tomorrow, but you can get out of it in the course of months through a transaction. And there's lots of people that want to get their hands on large secondary transactions. And it's not easy to get out of a multi-billion listed equity position. So we call it liquid, but it's actually not that liquid. If you actually try to get out of it, it will take you a few quarters to walk to get yourself out of it. So I actually think that end of the market is really transformational right now because it's creating the optionality for large institutional investors to not look at private equity as I buy and I hold for 15 years, fund to fund setup and so on. You can actually do active portfolio management. One way we were looking at this was, what sort of risk do you want to have? There's different risks, different types of risks in different stages of a fund's life cycle. So you can say, I want the more high alpha end in the beginning, but it's also more fee bearing, or I want the lower fee bearing, but more market end of the risk in the later years. So what is the risk that you want to focus on? And you don't have to go through the entire fund life cycle. You can use the tools that the secondary market now offers to be a lot more active.
Thank you.
I agree entirely. I mean, I think transformational is exactly the right word, and I think we're just going to see it continue. I mean, this year probably secondary volume, 90 billion, maybe it gets to 100 billion. And of course, it's a function of the primary market. But the point being made here is that it's become normalized, so that it's not frowned upon as it was in the past to have to sell your fund. I mean, we're a big buyer of secondaries, but we've also sold. So we actively portfolio manage. And I think that's absolutely key. And it's a sign of the maturing of the market, that we have these tools at our disposal. That plus the rise of co-investment, which is another innovation in the market which has been steadily growing. And again, a way to get more money into the ground, obviating the need for GPs to have to do club deals. Now they can bring their LPs into the deals, lowers the cost, brings in quite a bit of shadow capital as well, which is difficult to put into those numbers that we've heard. But it's yet another sign of more innovative ways of approaching the market.
Yeah,
I'd say on that, so that's an excellent set of reasons, and there's also gives more control to the LP to manage their strategy. So it's harder with a pure blind pool strategy. Now with secondaries and co-invest, you can actually create a strategy where you can see the assets or be a little more specific about the themes and sectors you're going in.
On the co-investment side, Peter, definitely a rise in numbers over the past years. How do you see this developing going further?
You mean in particular secondaries now? Or?
Co-investments in particular.
Well,
we've talked about secondaries.
I think we have seen a number of innovations in terms of financial intermediation, right? There is no sort of natural law that dictates that the only way to intermediate private capital is through a 10-year fund. So a secondary market has emerged. Co-investments have gained substantial momentum. New retail products are being launched. Some general partners have toyed with the idea to launch long duration funds. Not least because what we observe in the exit market is an increased amount of assets being involved in secondary buyouts. So there's a lot of value on the table, and there's no research that shows that secondary buyouts underperform. If anything, then secondary buyouts perform as well as primary buyouts. Right? So there's a need for innovative ways to intermediate capital that facilitates the way companies have access to private capital and LPs find ways to allocate capital to private markets. And my projection would be that we see more of these innovations going forward. The secondary market has now a volume in terms of transactions of about $70 billion. Now, is that big? Well, it's very big when you compare this with 10 years ago. It is tiny when you look at assets under management in private equity. We're talking about less than 5%. So a lot of room for further growth, in my view.
And another innovation that we probably ought to talk about, and it's really key for this industry, is the shift between defined benefit and defined contribution. So there are some products now that allow retail investors and pensioners directly to participate in private equity. And I think we're at the beginning of what I would characterize as a kind of democratization of private equity, so that the person on the street, the pensioner will be able to participate in private equity. Because until now, it's all been DB. DB schemes are mostly closed, or it's ultra high net worth, who can afford to pay the entrance fees or go in through feeder products. So I think this sort of innovation, retail products, 401k type products, investment trusts, investment companies, CCAVs, all of this will allow more money actually to flow into the industry, and that will really help. With that will come responsibility, of course, as well, as we move further down into sort of what's happening with individuals. And I think there the industry probably, we haven't got to talking about sort of opportunities and challenges yet, but the challenge for the industry is, as it grows bigger and it becomes more substantial, it counts for a larger part of the economy, plus it's delivering returns for pensioners, but also for the sort of the retail person on the street, there'll be more focus and more spotlight. So the industry needs to be much more aware of ESG, responsible investing, scrutiny, from regulators, policymakers, and all of that. So that I think is probably our biggest challenge going forward as an industry, is to confront that and no longer keep our heads below the parapet.
Yeah. Before opening up the room for questions, maybe let's touch upon the last point. So what are the potential threats and opportunities going forward, Elias, from your side?
Well, I think a lot of the threats, in my perception, it has to do more not with the real risks of private equity, but with more perceived risks of private equity. So when you have things that hit the papers, they tend to be isolated cases where one investment goes bust or something, and people sort of take that, and it creates an availability bias in the mindset of people and the regulators, and then suddenly private equity is all about this latest big buyout that was over-levered and went under. I think what's very important is for the industry to have a very strong fact-based rebuttal on how it actually operates and what actually is the risk that you are running, how should you look at it versus the listed markets, and so on. One of my biggest things, Helen touched on it, we've had this shift from DB to DC, and now most people's pensions are in DC schemes. And if I had to take a bet, I'm not an expert on this, I would say it's like 80% equities or something massively overweight listed equities. And we haven't had a downturn since that transition has taken place. Yeah. So private equity, at least as a way of diversifying a little bit the risk profile, I'm not saying it is complete because it's still equity risk, but it brings in an element of diversification. That's what we've seen in our portfolios. I'm sure all our colleagues here the same. So I as an individual can't do that right now, and I find that it would be tremendously helpful. So I think that has to get solved. Okay. And I think for example, in the UK, there was a study we participated in, sponsored by the British Business Bank, that did go after this topic. And yes, there are constraints, there's a fee cap, there's a liquidity requirement. But I keep saying, we sent a man to the moon 50 years ago. We can solve the fee cap and the liquidity requirement issue. There are ways around matters with sufficient will behind it.
Thank you, Elias. Peter, what are additional threats?
We could talk about endlessly about when the next recession will hit us.
Yeah.
Eventually, there might be one. I'm unable to sort of make a prediction, but I would agree that at some point we might be in a recession. Now, how should we be concerned as a private equity investor? Now, I don't know how many of you remember a paper that came out in 2009 that predicted essentially the end of private equity. It predicted that about 50 to 60% of the portfolio companies would go under because of very substantial amounts of leverage during the last boom period. 10 years later, we're sitting here, and it seems that we are competing relatively successfully with lunch. So there are a lot of people here who remain interested in private equity. The industry keeps on growing because there is substantial demand from companies for private capital. I'm not concerned. Now, private equity is part of the broader economy and is not immune to cyclical variations. Absolutely. But, the way I would look at this is more in terms of secular changes, what's going on in private equity in terms of financial intermediation, in terms of capital supply and demand. And here I see very substantial growth going forward.
Okay, thank you. I don't see the clock, but is there one?
Out of time.
Out of time. Unfortunately, ladies and gentlemen, thank you very much, panelists. Thank you very much, audience.